So today I'm going to be discussing equities, as always, with a little bit of history. And then along the way, I'm going to tell you what brand of stocks I'm wearing, how your investments have got into 9 out of 10 British homes, and I'm going to be answering some of the difficult questions that we've had this year. And actually, Phil, I think you were the last person to ask me this question. So the first third of this presentation is down to Phil. So hopefully, if it's bad, it's on him, it's not on me. So it's been inevitable. We've had a really good couple of years. But after you've had a good couple of years in markets, you start to get the question, is there going to be a correction? Is there going to be a crash? Particularly with the valuation, very widely publicized valuations in the US that we've spoken about the last few years. Now, that is going to handle the US valuation story later on. I'm going to look at this question slightly differently. I'm going to look at the long sweep of history of equity markets and look at the rhythm of crashes that we've experienced. But first, let's establish that history. So I've taken the three biggest developed stock markets in the world, the US, the UK and Japan. And I've gone back as far as I can with daily returns. It's very difficult to get daily returns. Normally we're looking at 200 years of history, but it'll be weekly or monthly, but I need daily for this. I've gone back as far as I can with daily returns. And you'll notice that since 1971, all of these markets end up in a very similar place. They have done between 10.26% return to 11.17% for the US per annum every year for the last near 55 years. Now, 10%, I need to get you excited about 10% because it's far and away from equity markets. Equity market returns are much better than any other asset class. It's going to be property, it's going to be commodities, precious metals, cash and gilts. But why do we get to earn that? That 10%, you know, will double your money every 7 years, quadruple it every 14, and octuple it every 21. But to harness that, we have to put up with this. Now, this is the UK experience. It's the line, it's the 10% return, but it's the drawdown. So it's basically how far you've gone from your previous high to your net to your low. And an easy way to think about this is you walk along the top of the chart, getting your nice 10% return, and every time the chart goes down, it's a ditch that you have to come out of. The journey with equity markets is anything but a straight line. And I think the fact that of the 55 years of data that I have with this chart, only 8 times has the calendar year return finished between 8 and 12%. So less than 15% of the time you get anywhere near that 10% return, but over the long run, it's quite predictable. Now, with that in mind, I actually want to read a quote from a legendary fund manager from 1994 called Peter Lynch. Now, he said, "You should study history. History teaches you the market goes down. It goes down a lot. The maths is simple. There has been 93 years this century." He's given this speech in 1994. "The market has had 50 declines of 10% or more. With 50 declines in 93 years, the market falls at least 10% about at once every 2 years. We call that a correction. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. So every 6 years. That's all you need to know. You need to know the market goes down sometimes." So I thought, well, that was 1994. We've got all this data. So why not go and see if he's still right? So the red line is where he gave that speech. We've counted them. So how many times has the UK market fallen 10% in the last 30 years? He said once every 2 years, and it's fallen 15 years. And how many bear markets has there been? There's been 4. So a little bit long on that, but .com, 2008, 2015 was quite a hard one for the UK. You notice it didn't result in a spike on James's VIX chart because the VIX looks at the US, but that was the European debt crisis and falling oil price of 2015. That was a bear market in the UK stock market. And also COVID. So there we are for our 4 crashes. So that might lead you to another inevitable question we get this year, is that if the market is predictable, why not just buy one market and they're all going to do 10%? Particularly this year because the FTSE, which is our most common yardstick with clients for performance, even though we are globally diversified, because it's so widely publicized, and particularly with the FTSE doing 23%, people might say, well, the FTSE's done 23%. Why have you done 17.5 in the growth fund? Well, I want to make 3 points. Firstly, over the last 15 years, our growth fund, which is the only fund that we can use to compare to the FTSE because it's 100% equities and the growth fund will be 100% equities. The growth fund is 70% ahead of the FTSE. Our second point is that of that return that we've had in the growth fund, we have had calls on the FTSE 100, we have had options on the FTSE 100, and we've held 2 of the top 10 performing stocks directly in the FTSE 100. But this is the most important point. The third point is that we would never hold exposure to just one market. And if we go back to our data, you can see that each market has idiosyncratic periods in history where there's a prolonged downturn. If you hold just one market, and if you held just the UK and you went into the 1970s, you nearly had a 70% fall. This is the UK experienced the worst. Out of all the global stock markets, the UK had the worst 1970s. It took you till the end of the 1970s to break even, and it took you till 1984 to break even in real times because inflation was rife during that period. The US is the same. US had a much harsher dot-com bubble and credit crisis. They call it the lost decade of US returns. We mentioned it last year. But again, if you'd gone just holding US stocks at the beginning of 2000, you have to wait 10 years to break even again. And Japan's a real basket case because in 1989, it was a massive bubble and it took you 30 years to break even. All those markets have had a 10% return over the long run, but have all had their own journey along the way. And this 30 years to make your money back is why we always say overpaying is the biggest risk you can take and it needs to be avoided. So with that in mind, it might be another logical question is that, well, okay, fine. We don't just hold one market. Equity markets are going to do this in the long run. Then why not just hold a globally diversified tracker? The gold standard of global trackers is the MSCI World. That's the FTSE 100 equivalent for the globe. But as James alluded to, it's become highly, highly concentrated in the US, as it did with Japan in the late 80s. And the US weight makes up 73% of the MSCI World now. So it's pretty much all US. You're just banking on the US doing well if you're a global tracker right now. And of that 73%, 6%, sorry, of the 100%, 6% of the 100% is in one stock, which is Nvidia, because that run-up has left it really highly concentrated. Now, that's not a particularly responsible way to build your equity exposure. We do it very differently, and it doesn't matter whether you are, this is the 60% of the cautious fund, the 85% of the balanced fund, or the 100% of the growth funds. This is what your equity basket will look like, the bit of your funds that's going to drive those long-term returns. You have exposure directly and indirectly to nearly 4,000 stocks. The USA weight is 33%, and within that 33%, you've got small caps, you've got Russell 1000 value, you've got S&P equal weighted, and a select group of stocks that we pick for their characteristics. And your largest stock of your equity portion will be Barclays at 1.6%, purely by nature of it being up 238% since we said it looked attractive a couple of years ago. So we try to limit that concentration. So hopefully you've taken away from that, Ian, that you can't just buy one market. Equity markets are going to be bumpy. We're going to try and iron out those bumps. You can't buy one market, and we're trying to drop equities in there responsibly. But what have we been dropping in your basket this year? So the FTSE last year was 40 years old. Of the 100 stocks that were originally in it at its birth in 1984, there is only 25 left. Now, we bought one that was there at the beginning, and the reason it survived, has been one of those 25 survivors, is that it adopts the same principles that we adopt. It's called Associated British Foods. They were founded in 1935 by a Canadian baker called Garfield Weston, sorry. And they became a baking powerhouse over the first 20 years. And then they started acquiring businesses to diversify that revenue. They started with Ryvita, they bought Twinings, they bought Fine Fair grocery stores. They've built up this incredible basket of diversified goods that 9 out of 10 British homes have at least one Associated British Foods product in. And this is the last time we've done this presentation, having spoken to clients over the last couple of weeks, many of them have had Twinings tea and some Dorset cereal before they've got here. So you've interacted with 2 beforehand. But building up that core portfolio responsibly allows them to dip their toe into higher risk stuff. In the same way that we can build up your core exposure responsibly, we can start adding a little bit of your exposure to emerging markets. We can add a little bit of your exposure to smaller companies. We can tilt to value. And in the same way that we do that, Associated British Foods decided to seed invest a mass market fashion proposition in Ireland in 1969 called Pennies. Now, Pennies today is better known as Primark. Associated British Foods hold 100% of it, and it's further diversified that revenue over the last 50 years. But whilst this is nice, we don't buy, it's a nice story, we don't buy stories, we buy valuation. And the valuation with Associated British Foods is very attractive. As a multiple of their profit, they are the cheapest that we've seen them since 1997. And again, using that metric, they're a 37% discount to their 10-year average. So, you know, we're always screening stocks and this one looks attractive. And as Warren Buffett would say, whether I'm buying stocks or socks, I like to buy quality merchandise when it's marked down. So we bought the stock, but also my socks are £7, cotton rich, 7 pairs for £6. So please fill your stocking with them and support the companies in the portfolio. And last year we flew around on a BA flight because we just added IAG, which is the holding company for BA. And we wanted to show you where we were finding value outside of the US. And we took a flight to Italy and we talked about a company called Unipol Gruppo and an insurer, an Italian insurer. Since we bought that, it's up 266%, but we are back in Italy for more bargains. And this year we've bought the oldest bank in the world. Not all companies survive, some are survivors. That 1472 is when they were founded. They are the longest running bank still in operation. We actually financed this using selling a US bank with Citizens Financial Group. We bought that early in the year, but we sold it for 35% and we tweaked our model. We started not ranking regionally, but looking across the globe. And that really highlighted that even the cheap stocks in the US look quite expensive when you compare them to stuff like Monte dei Paschi di Siena. That was a third of the price. It pays 3 times the dividends. And not only that, it's finally stabilized. They've gone back to paying a dividend after 13 years. They had quite a rocky credit crisis, so they have some losses on their books, but they're able to monetize those losses by booking them against profit. So corporation tax is around 24% in Italy. When they have these deferred tax losses, they can use them to not pay corporation tax going forward, which means an immediate 31% uptick in profit. So they've used those to go and buy other banks and then immediately enhance the profit. So not only are they attractive on a fundamental level, they're also monetizing their experience between 2008 and 2012. And it's really attractive for the banks that they're buying. They actually bought another bank that was just behind this on the model. So they're becoming a conglomerate of value banks in Italy, and we really like it. So that's been added to the portfolio a couple of months ago. So lastly, I like to give you gift ideas so you can support the stocks in the portfolio. So you can give the gift of giving to yourself in your portfolio by supporting the stocks in your portfolio each year. Unfortunately, British Airways is actually out. We bought it for about £2.40 and sold it for £3.80. So you don't have to take flights off of the wish list because LATAM Airlines is in. So unfortunately, you might not be flying to Italy, but you might be flying to South America. This is part of our emerging market exposure that we talked about earlier. It's our first Chilean stock that we bought directly. It's up 80% since we bought it, but it looks attractive and we're building up that emerging market portfolio to sit along your core investments as well. And lastly, consumer electronics are back on the wish list. This is the second time Lenovo, a Hong Kong-based computer manufacturer, has appeared on the wish list. We actually bought it in 2022 for about $7.5 Hong Kong dollars and sold it for over 11 in 2024. But whilst those bumps in the road can be painful, they also throw up opportunities. And during the tariff period, This fell back to the price that we were paying in 2022. We know the company well, so we did our research and we bought it. And within a few weeks, once the delays were mentioned, once the delays came in that James discussed, it was up 20%. So, you know, those bumps may be painful, but they spark up opportunities. But also, if you can keep your head, it really can enhance your long run returns. And nothing says that more than with the growth fund. If you bought in the depths of the financial crisis in 2009, you would be up 589% today. So on that, I would like to wish you a very Merry Christmas. I hope that's answered some of your questions, but please feel free to fire any at us later on. Merry Christmas and a Happy New Year. Thank you.